Cool. All right. Well, we've just gone 7, so I think let's get started. So, welcome everybody to the Farm Finance Getting Prepared webinar series. This series is run through Agriculture Victoria through the Smarter Safer Farms initiative, and we're really excited tonight to present the first one, the business case. So I'm Sarah Wallace. I am the Young Farmer Coordinator, and I get to organise this program and some of our other activities that we do in the Young Farmer Project. So keep going with your chats and introducing yourself and any rainfall totals, but we don't want to boast too much because we know that a few people missed out. So but feel free to pop in your location and yeah, I'm keen to know where everyone's from today. So yeah, I guess this series aims to provide you with a bit of an introduction to what farm finance is, and to help you sort of get started. So it's a bit of introductory level. We want you to ask lots of questions, so that's why we want everyone typing in the chat, and we will have specific little stops in the program for tonight, so you can ask your questions. And I guess I'd like to acknowledge the traditional owners of the lands which we're all meeting on tonight. I pay my respects to the elders past, present and emerging, and the elders of any other communities who may be joining us tonight as well. So we are going to be on Zoom. So I'll just get Jane. There's a couple, I might just swing the slides along.
Oh, sure thing. Yes. There we go. That's working.
So we are going to do a little poll to start with as well. But yeah, I'm Sarah, and we've got Pippa here, Pippa, can you give us a lovely wave? There she is. Pippa's going to help us drive the technology tonight, and we've got Jane Foster from ORM who will introduce herself in a minute. I will just do a little next slide.
Yeah.
Please. And we can just, I'm sure you guys are all across Zoom by now. If you haven't, just remember, if you're joining us, you can mute. You can share your video if you like. It's nice to see you, but if it is creating connection issues, take your camera off. And we will be using the chat function. So that's that little bubble with the words chat under it. And make sure you type in to everyone so that we can all see your comments. So that's just a little overview of Zoom. And then the next slide just shows us that, yeah, this is a part of a webinar series that is we're going to cover tonight, starting off with the business case. So well done for registering for this one. And at the end of tonight, we'll share the link so that you can register for the upcoming sessions as well. But we've got the 8th of April, 29th of April, 13th of May and 27th of May as well. So lots of topics to cover with those. And so thank you for joining. I think everyone's pretty sorted. We've got 70 mils in Northern Vic. We've got someone from the Mornington Peninsula. I've got a few from around the trap, so that's great. So thanks guys for joining. Keep your questions coming in the chat. I will now hand over to Jane to introduce herself and tell us a bit more about what we're going to be covering tonight.
Great. Thanks very much, Sarah. So yeah, I'm very privileged to be with you all tonight to present some information around farm finance getting prepared. And we're starting off the series tonight with the business case. So this really sets the very fundamentals of things that you might have to sort of prep or plan for, particularly if you're in the early stages of getting a business venture started or a farming enterprise. And it also helps because if you do approach a finance provider like a bank for some funding to pursue your farming enterprise, some of what we will cover tonight is the sort of information that they would be looking to understand about your business. So it's really helpful if you've gone through and thought through some of these concepts. And then it also helps them in understanding better what you're doing, trying to achieve. And they also get quite a bit of confidence when they're dealing with someone who's running a business enterprise who understands, these facets of their business. So just by way of introduction, I am Jane Foster and I work with ORM Consulting and Communications. So we're a firm based in Bendigo, Victoria, and we do quite a lot of consulting work one-on-one with farming enterprises, and I do quite a bit of that in my role here. So this is the sort of practical stuff that we tend to assist clients with when they're maybe setting up a new enterprise or looking at getting started. So that's basically a summary. I've spent about 17 odd years in banking and finance. So I used to be probably the person that if you made an appointment to come and see a agribusiness finance person, you might have encountered me back in the day. So I do have quite a lot of first-hand experience and understanding of what it is as a banker that you're trying to understand about a business if you're looking at a loan application. So I thought tonight, and I do see that the chat's been quite busy, so that's great, and it is very helpful with me keeping this interactive. So keep the comments or thoughts coming, and we will be stopping at some segments through the presentation to take questions. Just so we can keep the flow of tonight running a bit, I'll actually run through parts of the presentation and take questions at different segments. If you do have one though that you think of, feel free to pop it in the chat and we'll try and keep track of that as we go. And that would be great because that makes it a really interactive session. So I did think that tonight, because we are getting started on planning a business case, I thought I would give you a little bit of a story with some local relevance to Bendigo. So some of you joining us tonight may be familiar with Hazeldene's. It's quite a large poultry processor, but they're what we call a very integrated business because they really do manage poultry production right through, obviously have a number of grower sheds set up around the place, and then that comes into their processing plant, which is located just outside Bendigo at Lockwood, which you may have seen if you've driven around the area. So the reason I've sort of drawn on this example is because particularly if you are younger and getting started out in a business enterprise, it can be helpful sometimes to hear stories of how other businesses have started. And I suppose it also shows that, sometimes these things grow over a period of time. So where we start today might not be where we end up in 10, 15, 20 years. So I think the key thing there is to at least make a start, and then we see where we can get to from there. But Hazeldene's, the story around how that business started, there were two brothers, and that was Jack and Dick Hazeldene. And Jack had a number of poultry that was running in the backyard at home that he used to, produce a few chickens, and I'm not sure whether he was producing eggs as well. But anyway, unfortunately, just with the timing as it was, Jack had to go off and fight in the war. And so when he left, he actually asked his younger brother Dick, who was 10 years old at the time, to just look after his chickens while he was away. And as it would happen, it was quite sad that Jack actually died in the war and never returned to take charge of his chickens again. And so Dick, as a 10-year-old, was left in charge of these chickens in the backyard. And as time went on, obviously, he kept maintaining them, and he got involved in them as a bigger commercial business. And over time, eventually started up processing plants, and then they expanded to grower sheds. And now Dick's children actually run the business, and there's 3 of them, and some of the grandchildren work in the business as well. And it's quite a substantial family business. And last time I saw it, did make sort of BRW list of 100 highest turnover family businesses. So it's obviously grown from, at the time, what were very humble beginnings, and it's grown into quite a substantial enterprise. So I thought sometimes if we're starting out, it might be nice to ponder some of the stories of people who've gone before and started up businesses, and, you know, look at what's potentially possible. Sometimes we just have to have a bit of imagination and somewhere to start, and you just never know where you could end up. So I think it's a great story, and certainly comes from regional Victoria, so it's very local to many of us. Okay, so the way we're going to...
Thanks.
Sorry, Sarah?
Yeah, no, hook in, Jane. I was just going to say, we'll just probably run that poll find out what industry people are from too, Jane.
Sorry, done that. I miscued. Apologies, everyone. So you should have hopefully just seen a poll land on your screen. So we just be great to get a gauge across the group here as to what industry you represent or are involved in. So we might give you a few seconds to nominate your industry. Hopefully you can all see that on the screen. Throw us a chat if you can't see it. And you just make your selection and click submit. And then hopefully that'll be sending some results back for you, Pippa. Are you seeing something there? Great. Okay. Sorry, Pippa, did you want to go through some results, or are we?
Yeah, I can talk to them. I don't know if people who are taking the poll could maybe see them, but we've got 7 people in cropping enterprises, 8 have selected sheep meat and 3 sheep wool, and we've got 2 beef, 1 dairy, 1 hort, and 4 who have selected other. So if you've selected other, if you could pop in the chat and tell us what that other is, that would be great as well. So thanks everyone who's responded to that. That's great.
Thanks very much, Pippa. So from that summary, I can see we've got quite an array. So that's really good. I'll draw on some of those industries as we go through tonight's presentation. And I can also help with some, practical tips and advice if you have any specific questions as we go through. So, okay, the structure of tonight. So when I was looking at the business case, I thought this, basically we approach it in a bit of a step-by-step process tonight. So we'll go through each of the areas that are pictured on your screen right now. So that's production systems, and we'll have a little bit of a look at cost structure, and I'll just explain a little bit about that and why it's important. We'll look at some finance structure, and that's hopefully to give you a few practical examples on where you can look to for some finance and the types of financing that you could possibly access. We'll look at business structure. So that'll be more around that legal entity and how you trade with any farm enterprise that you're involved in. And we'll look at cash flow in some broad detail. I won't go into really detailed explanation or demonstration of that, because you can join us on the next webinar where we'll be going into that in very great detail and explaining it very thoroughly from end to end for you. And then finally, we'll finish up on some information around matching resources. So that's doing a bit of a audit of what resources we require and how or where we might go about obtaining them. And so to kick us off, we're going to start off with having a look at production systems. So basically, as we asked you which industries you were from, those industries all would represent their own production system. So when I talk about production system, what I'm referring to is that what it is that you produce and the organisation of your business enterprise to produce the relevant outputs. So these are some examples of what we would call agricultural production systems. So there are things like croppings demonstrated there. There's sheep for meat. There's some pigs there, which is its own system. There's poultry. We've got horticulture, dairy, and sheep for wool. So there might be some overlaps between some of these, such as sheep for meat and sheep for wool. You might be doing both in the one enterprise. And then there might even be some cropping that comes in. So there is the option to sort of integrate some of these because they're quite compatible, whereas others tend to be a bit more standalone. So your horticulture and market gardening type of enterprises, you don't see them integrated so much with any of the other systems. So that's basically what we mean when we're talking about a production system. So it's how you go about doing what you do and basically what you produce to sell at the end of the day. So when we're thinking about this from a banking perspective, or if we're looking at a finance application, and similarly when you're establishing your business case, these are some of the things that you might need to give some thought to and put some details around. So things like a resume of industry experience. So that really refers to, as an individual who wants to commence a farming enterprise, do you have experience in that enterprise or running that sort of production system? So sometimes that might be that you may actually have some cropping experience, for example, but then you may be expanding out into running livestock. So we would say you probably have quite a good resume of industry experience in terms of farming in general, good experience in cropping side of things, and probably starting to commence gaining experience in livestock. So some of these production systems in agriculture or farming have some fairly specific skills, and then there are obviously some more general ones that are probably common across the board. And so when you're thinking about what it is that you are going to do, you need to look at what are the skills required to operate that enterprise or farming system. So then you may have some of those skills. You may go out and source some of those skills by undertaking some training or development. You might attend a webinar like we are tonight as a starting point to your journey on gaining those skills. And then there might be an opportunity, if there's some other things that you're not quite so expert in, that you would hire in to help out with operating the business. So these are some of the things that when a bank is looking at a loan application, and I will sort of continually refer back to why these things are important in terms of finance, because we're really looking at, in terms of farm finance, how you can put the best picture and case forward to represent to someone what it is that you do and why you know, they should have confidence in potentially lending you money. So other things would be technical capability. So that's around, do you have a background or experience in actually being able to produce the output efficiently? So in terms of beef cattle, that might be experience in terms of animal husbandry, and just experience in being able to manage the livestock. And so that's at the technical level, being able to ensure that we can conduct the farming operation that we're involved in. But second to that, and I'd say equally as important, if you're going to own and operate the business or the farming enterprise, the management capability becomes a really important factor as well. So that's around things like making sales, managing your expenses, and ensuring that you maintain regulatory compliance. So in a number of industries, there are very specific regulations about how they operate that you'd need to comply with, and each one would be different, but they need to ensure that you understand what they are and that you can maintain compliance. And then another thing to be able to think about and potentially explain to a finance provider is whether there's capacity for future growth and development in your business. So that would show that you're quite forward thinking and that you have a good plan on where you are now and where you want to be in the future. So I might give you a quick example of what a business enterprise or a farming enterprise. And for this example, I've just elected to nominate, say, a feedlot beef production. So that's where obviously you bring cattle into a more intensive sort of system, and you'll feed them grain and fodder to be able to produce cattle that are ready for market. So you're going to have to conduct a number of activities to be able to do this. You'll source and buy cattle. So where do you go to do that? There's markets, there's online auctions, or you might be able to source cattle privately. So then going on to the next step, once they're in a feedlot scenario, you'll have to manage and analyse feed and nutrition. So you'll be trying to monitor and manage weight gains, for example, because one of the key aspects of feedlot success is the kilogram gain per day per feed. You'll also have to acquire, store and feed out grain and hay. So obviously that's quite an essential input to a feedlot type operation. So how would you do that? Do you have some networks that will assist you with that? And then how do you manage the logistics and the storage of the grain and hay? Obviously, there's an element of animal husbandry and welfare. So what's your expertise? And then who else would you have to assist you in that manner? So obviously, you may call on veterinarians, or you may also have a consultant that can assist you with managing those aspects of the business. At the end, once we've successfully achieved the required weight gain, we'll have to sell the cattle. So you'll need some relationships with buyers. There's sometimes contracts that are available so that you know what your set end price is, which is helpful in being able to manage your cash flow. Or you might sell through markets, which is obviously a little bit more unpredictable. Once we've done all of those actual activities, we need to measure profitability, and we can do that on basically our buy-sell margin. So that's what we bought the cattle in at, what we were able to sell them out at, and then less all of the costs of production. And then after those costs, we basically have our profit at the end of the day. And a really important aspect, and one that a lot of people find one of the most challenging parts of being in a business, is if you have to manage labour. So that's meaning casual or permanent staff to assist. And then further to that, obviously you need to ensure that any approvals that you need to operate commercially are in place before you commence, and just ensure that you will be able to sell through markets and there's no impediments to being able to do that because you don't have the right approvals or that that can't be undertaken. So that's a quick example for you on what we mean by production system and looking at your skills and a resume of skills and experience. So I know as a banker, if I was talking to someone in a farming enterprise, I really wanted to understand all of those aspects about what they did so that I could assess their management capability and understand that they could successfully undertake the activity that they were looking to commence. Okay, so that wraps us up on production system. And the next part of this structure that we'll look at tonight is cost structure. So what I'll do is I'll work through cost structure, and once we get to the end of that, I'll stop and just offer an opportunity for any questions that you've had over the first two segments of tonight's webinar, and then we'll move on to the next segments. And once I've done finance structure and business structure, I'll offer another opportunity for questions. And then once we've got through cash flow and matching resources, we'll be getting towards the end of tonight's session and we can have any final questions, thoughts or comments. Okay, so what does this cost structure relate to? And just excuse me, I'm going to have a sip of water. Okay, so by cost structure, we're actually looking at what the expenses of the business look like, or the farming enterprise. So there's two very distinct costs that we tend to look at when we're assessing a business cost structure. And you'll see there in red, we've got variable costs of production and fixed costs of production. So the variable costs of production relate to these things called cost of goods sold, which you'll see across to the left-hand side. So what they are is they're the things that will vary relative to how much production you undertake. So for example, in the feedlot scenario that I just went through, the number of cattle in the feedlot is going to alter the grain and fodder consumption. So if I have no cattle in the feedlot, there should be no grain or fodder consumption. Then if I move to 10 cattle, there'll be an amount of grain and fodder consumption. And if I move to 20 cattle, you would expect to see that consumption roughly double. Now, obviously, the grain and fodder, either you've had to grow it, which is less usual in some circumstances, or you have to buy it. So basically that grain and fodder I would refer to as a cost of goods sold, because it's directly related to the production of the beef cattle at the end of the feedlot. This is different to the costs we refer to as being fixed costs of production. So you'll see there against fixed costs of production, we've got things like overheads, wages and salaries, finance costs, and depreciation. Now, overheads could include a number of different things. If there's power, electricity, telephone bills, accountancy fees. So how these are different to the variable costs of production is that these things exist in the business fairly much irrespective of how much production is undertaken. So they tend to stay fairly stable unless there's something significantly changed within the business. And even if you do nothing, as in you don't put any cattle through the feedlot, if you employ somebody, you might still have to pay them a wage. Now, I understand, obviously, if you employ somebody and there's no cattle in the feedlot, well, you may not employ them for too much longer. But that's the basic principle of a fixed cost, that unless you make a significant change or vary something, they continue to be incurred regardless of what level of activity you're undertaking in terms of production. So if I just roll through the basic statement that I've got demonstrated there. So your income would be the proceeds from all of your sales. So if it is in a feedlot scenario, then that's the proceeds from the sale of cattle, and that's probably net proceeds. So obviously they cost you some money to buy, and then you sell them out at a set price, and the net difference would be your income. And then you've got your costs of goods sold. So that would be things like your fodder and grain that relate directly to the production. So once we arrive at our income and we deduct our cost of goods sold, sorry, I'll just move my arm so my light goes back on. We get to a term that's referred to as our gross profit, or GP. So that, in the examples I've demonstrated, for example, in the first column, we had $200,000 of income. Our cost of goods sold was $100,000. And so our gross profit is $100,000. And so from our gross profit, we then look and take our expenses. So our overheads, any wages or salaries, finance costs, depreciation, and basically all of those fixed costs in the business. And once we've deducted those, we get to our what's called net profit before tax. So we see that we made a gross profit of $100,000 in the first example there. We've deducted $10,000 worth of overheads, $40,000 worth of wages and salaries, $2,000 of finance costs, $4,000 of depreciation. And once we've deducted all of those costs, we get to a total of $44,000 net profit before tax. And you'll see that the total expenses, so your overheads, wages and salaries, if we added those up, it's a total of $56,000. So that leaves the net profit before tax of $44,000. And then I've made an assessment of tax. So I've just used a company tax rate, about 27 cents in the dollar. So on $44,000, that means we would need to pay tax of around $11,880. And so once we've deducted the tax, we get back to our net profit after tax. And that would then be $32,120. Now, the reason I've gone through this in a little bit of detail for you is because if you are talking about budgeting and finance, then you'll probably hear these terms referred to quite regularly, particularly cost of goods sold, gross profit, net profit before tax, or sometimes you'll see that abbreviated to NPBT. So if you see that, it stands for net profit before tax. And then we've got net profit after tax, or NPAT. So just to clarify, if you see any of those terms, hopefully going forward, you'll have a bit of an understanding of what they mean. And the reason that I've gone through and talked a bit about variable cost of production and fixed costs of production is because the structure of these costs in your business have quite an important bearing on the risk profile that the business has. So essentially, the higher the fixed costs of production are, the more risk that may be present in the business, because those costs are going to exist no matter how much you're able to produce. So they're very inflexible in some ways. Whereas the variable costs of production are directly relative to how much you're able to produce. So if your production or sales were to drop away, then those costs will also decrease. Whereas the fixed costs of production are going to stay the same generally, no matter whether you produce $200,000 of income or $50,000 of income. And one other thing I thought to demonstrate as an example there is, let's say we then go on and increase our sales to $300,000. And so you'll see that at $300,000, our variable costs of production do increase. They go to $150,000. And so that's worked out at 50% of 300,000. And similarly, in the example before, the 100,000 was 50% of 200,000. Because we tend to see that cost of goods sold as a percentage in businesses does stay relatively stable like that. So in the second example, we've now increased our sales or income by 100,000. We deduct our cost of goods sold. We then get to our gross profit. In this example is 150,000. Now, generally speaking, many of our overheads will stay at the same level regardless of that increase in sales. One thing that I did factor in this example is that we may need a little bit more labour to assist us if our sales or production has increased. So I've factored in an amount of 55,000 in the second example. Basically, if we haven't had to borrow any more money, our finance costs should stay the same at $2,000. And if we haven't purchased any more assets, our depreciation will stay the same at $4,000. And so in the second example, we can see that net profit before tax equals 79,000, and our tax on that is about 21,330, which gives us a net profit after tax of $57,670. So when I was in banking and finance, we used to very much look at the split of variable to fixed costs in businesses. So if a business had about 50% of its costs being variable and 50% of its costs being fixed, that was a relatively even balance. So we would know that if they did experience a bit of a downturn in income or sales, their costs would be able to decrease, and then the reduction in profit would not be so severe. Compared to a business that might have only had 20% variable costs and 80% fixed costs, then any reduction in sales was going to essentially lead to a more rapid reduction in profit because they were less able to reduce their expenses in line with their reduction in income. So hopefully that's made that a little bit clear and at least clarified some of the terms that you'll hear when talking about cost structure in business. And it would also help you to assess and explain to someone what potentially the cost structure in your business looked like. So just to give a few other industry examples, in cropping, for example, chemical and fertilizer can be considered variable cost of production because they will vary dependent on how much crop is produced or planted. And so that just gives you a bit of a reference point as to what a variable. So I might just pause there for a moment and just check in with you all and see if there's any questions that you wanted to send us through in the chat. And I think if we don't have a question, we might have a poll that we're going to ask you to participate in again.
Oh, Jane, Liam's onto it.
Oh, there
Where
we
does
go,
stock
Liam.
purchases sit?
Yeah, very good. So by stock, I'm assuming we're talking about cattle and sheep. So normally what you'll have in your financial, I guess if I'm looking at financial statements, we'd look at what's called a livestock trading account. And so, yeah, that's perfect, livestock. So we'll have a livestock trading account. And so basically over a period of time, we'll buy cattle or sheep or whatever livestock it is that you're dealing with. We'll buy them in and we'll sell them out. And hopefully what we sell them for is obviously a higher amount than what we've paid to buy them in. And we basically take the difference between the selling figure and the purchase figure will then come down to form our income. So hopefully that's clarified it somewhat. So it's a bit like a buy-sell account, and then the difference between those two amounts, what we've been able to generate through sales less what we've had to pay to purchase, becomes our income figure. So it's almost a little bit at a level above where that income statement is. So hopefully that's clarified that for you, Liam. And probably one of the key things with being able to successfully manage a business that might trade livestock, so buy them in and sell them out, is being able to buy them at the right price and then being able to sell them out at a price that enables you to generate profits at the end of the day. Okay. Do we want to do the poll still, Sarah or Pippa?
Just looking at the time, Janie, thinking at 7:40, we push on for this one? And
we definitely can do that. That's no worries at all. Okay, so moving on. Okay, so now we are going to talk about finance structure. And so with finance structure, we're looking at what we need to operate the business and basically how we come about acquiring the money to make those purchases. So I've got an example here to work through with you tonight. And I've kept it quite general, so if you do have any more specific questions, feel free to shoot those through and we'll try and come to them when we break off for our next question segment. So here I'm looking at the capital items that we might need to operate, and this is a livestock type of operation. So let's set the scenario that potentially you might be able to lease a parcel of land and purchase some livestock, which then you buy, raise and sell on. So to do that, what sort of things might we need? Well, some plant and equipment, just of general nature, things that help us in being able to manage livestock. You might need a tractor. Might be instances where you need to be able to deliver grain and fodder to the livestock. So we might need a tractor for those sorts of things. You might also just need a vehicle to be able to transit yourself around and attend where the cattle are. Maybe a quad bike or a side-by-side, which just assists with general farm work and potentially if you need to get cattle into yards and things, but those sorts of pieces of equipment can help with that. And then clearly also we're going to need some livestock to stock this leased parcel of land. And so I've tried to give some examples over on the right-hand side of how might we finance some of these costs, because you'll see there as a total, if we're going to conduct this this livestock enterprise, we might need about $140,000 to get it up started. Now, some of those figures you might be less in an example. I mean, we could get a slightly older, smaller tractor. The vehicle, we may choose something a bit different. So this is just a rough example for you to give some thought as to how we could fund or find the money to acquire these assets. So for example, the tractor. So we may be able to go to a finance provider and get a machinery loan. So that would be, and I think I've just, you'll have to, sorry, I just realised there the machinery loan says 20,000, but actually the tractor's 30,000. So I've just flipped those around. But what I'll do is talk through them. So a tractor at 30,000, you can obtain a machinery loan. There's quite a number of providers that would be able to assist with that. And so what that means is they actually use the tractor as security for the loan, and they provide the money to purchase the tractor, and then you can pay it off over a time period that's agreed under the contract. A vehicle, you may be able to also get a car loan. So again, it's a loan directly against the motor vehicle, and the money is provided up front to purchase the vehicle, and then you can pay that off over an agreed time frame. In talking to a number of livestock agents, they suggested that the livestock, we've put there an initial cost of $60,000. They may be able to provide finance of about 50% of that value. So that would be, say, a livestock loan of around $30,000. And then it would be a case of the remaining items. You may have to have some savings, and the savings will pay for the other $30,000 of livestock, and it might pay for the quad bike, and it might pay for the general plant and equipment, because those items individually might be a little bit harder to get finance on. So that represents quite a realistic, practical example of how you might be able to at least commence an enterprise without having to find a large amount of savings. There's still about $60,000 worth of savings factored in there, but you'll see we've used some types of finance that are pretty readily available, as long as you can demonstrate that you have the capacity or can meet the repayments that are agreed to under the contract. Okay, so moving on from there, I'll go over the debt and equity and how that's explained. So I think you'll all be quite familiar with the term debt. So debt is usually money that we borrow from someone, and eventually they'll want us to repay that. And so that's where in that first point, we usually find that, so debt's provided by a third party, and they'll usually set a rate of interest that they're going to charge us for our use of the money over a period of time. Whereas equity is usually our own money that we've put into the business. So it's funds contributed by the business owner. And obviously we don't generally charge ourselves a rate of interest. What our return on equity is usually our profits that are available for us to use to reinvest in maybe acquiring additional livestock or upgrading some plant and equipment. And so assets include things like cash that we have, plant and equipment, any livestock, any land and other inventory that are owned by the business. And then the graphic there tends to demonstrate that the total assets of the business are usually funded by either debt or equity. And the percentage of equity or debt in the business is something that does reflect the risk profile. And you might have heard banks talking about loan valuations, and they'll lend to about 50, 60, 70% of an asset. And so what they're essentially saying is if they'll lend to 50% of the value, so they'll give you debt of 50%, and then somehow you'll have to acquire or provide the 50% equity. And so the total value of the asset will be paid for half by the debt that you've taken on and half by your own money that you've been able to put in to pay for the full amount. Okay, so now following on from that, I'm just going to run through a couple of quite common finance options that you might have heard spoken about, or might at some point have used, or might use at some point in the future. So we often have things like overdrafts. So these are used for what we call working capital, and I'll explain a little bit more in detail further on what working capital is. And we generally use it to pay the day-to-day expenses of the business. And an overdraft is used to basically allow us to pay the expenses, even if maybe we haven't received enough income in our bank account. So it's essentially a credit limit on our business trading account. Then we might have something called a term loan. So a term loan is basically describes what it is. It's a loan provided over a length of time. And so that might be used to fund purchase of things called fixed assets. So that could be land or infrastructure, things like sheds or yards or water infrastructure. And so that might be the scenario where we provided a loan and it's to be repaid over 10 years at a rate of interest. And the payments could be made on a monthly basis. Sometimes you might see them quarterly or half yearly, although that is a little bit less common. And they're referred to as term loans. These are all really business finance terms. So you won't see, I haven't mentioned there things like home loans, which you might be quite familiar with, because generally in owning, operating a business, it's not, a home loan's not really the type of finance that a bank might be looking to provide you with. Home loans are generally used to purchase residential houses. You might have heard the term equipment finance. So that's used to finance plant and equipment, and that refers back to the previous example where you might buy a tractor and you could do that on equipment finance. So the finance provider will take the security being the tractor and they'll provide a loan against that asset. There's also stock loans, and by stock loan I mean a type of loan used to finance purchase of livestock. So I spoke about that in the previous example as well. So that was where you might have $60,000 worth of livestock and you might be able to obtain a stock loan for 50% of the value. So sometimes if you're talking with a stock and station agent or livestock agent, they may be able to provide a livestock loan. And so that might enable you to purchase, say, the $60,000 worth of livestock, and they provide $30,000 from the loan, and you provide the $30,000 balance to pay for the livestock purchase. There's also something called a vendor loan. So that might be if you are, it isn't a very common type of finance, but if you are buying land, sometimes that type of loan is used. So that's essentially when the person selling the asset to you, which is often land, would actually be the one that lends you the money. So they'll obviously do that potentially at a rate of interest and enables you to maybe buy the land and pay them at a later date for the balance of whatever you owe them. Private loans, so they might be just loans from any non-bank lenders. So you might have a private individual person that has access to an amount of money that they're happy to lend you for a period of time. And then one that was probably not uncommon, not sure that it's as widely used now, is a seasonal crop finance. So that would be quite a short-term type of loan where you're provided with a loan to basically pay for any cropping inputs, because obviously those have to be acquired and paid for before the crop is actually able to be harvested and sold. And then as you harvest and sell the crop, then you would repay the seasonal finance. So it's intended to be short term and just fund those crop inputs until you receive the income from the grain. Okay, so I think we're about on to the next segment, which is we're going to look at business structures. So by business structure, we're referring to the actual legal entity that you conduct your business operations through. So as on the slide here. The 4 most common types of business structures in Australia are sole trader. So that's quite simple, and as it says there, it gives you full control. A company, that's slightly more complex, but it limits liability somewhat because a company is seen to be a separate legal entity. You could have a partnership, which is made up of 2 or more people, and then you do distribute the income or losses. And then there's another type of entity, which is a trust. And you might have heard these terms in general discussion, but basically a trust is business operations conducted for what they call beneficiaries. So it's just a type of legal structure. And ultimately, if you're owning and operating the business, you might be the trustee who's responsible for business operations. And then the people nominated as beneficiaries, will they receive the financial benefit of any profits from the trust? So a sole trader is, if I was to start a business and I just traded as Jane Foster, then I'm operating as a sole trader. It's just me, and I'm an individual person trading under my own name. A company is something that has to be registered. So it is a legal entity, but you do have to register it through ASIC. That's the Australian Securities Investments Commission. So a company, you might have seen these, or you might be familiar with them because, for instance, I could start up a company called JF Proprietary Limited. So I would register that company with ASIC, I'd be a director, and I would, as a director, manage and operate the business. But it is considered to be a separate legal entity to Jane Foster, the individual. Whereas a partnership might be Sarah Wallace and Jane Foster operating a business together. So that's 2 individuals, and we're operating a business, and we'll be actually able to take a share of the profit from the business. And the trust is, as I described it before, it's a legal entity, has a trustee who basically controls operations, and then it would have beneficiaries who take the financial benefit from operating the business. So if you were to be looking to get a business up and running, you may initially start off as a sole trader because it is a slightly less complicated scenario, and you can pretty much commence trading as yourself. And then down the track, as your business operations became larger, you might actually decide or determine to register a company, and then you trade as the name of the company, Proprietary Limited. So these are important aspects, because if you do look to establish finance, one question they may ask you is, what's the name of your trading entity? And so that's where you'd need to know, are you a sole trader, a company, a partnership, or a trust? And from a bank perspective, each of these has very different requirements for lending money. So moving on, I'll just very quickly, and this is straight from the business.gov.au website, so you could even refer to that if you wanted to know a little bit more about it. But it just runs through each of those options: sole trader, partnership, company, and trust, and gives you a few of the important characteristics of each. So for an example there, is the structure difficult to set up for a sole trader? No, and a partnership's not difficult either. But companies are slightly more difficult because you do have to register them, and a trust is more difficult again because you will need someone to draw up some documents about the trust, which will stipulate who the trustee is, who the beneficiaries are, and some of the rules that the trust has to operate under. And so again, it has that there's, you know, is it expensive to register? And it describes that. And it goes on to basically outline all the different facets of each. So I won't go through them all in detail, but they are there, and you can go to the website to view them in further detail if you wanted to. If you are starting up a business enterprise or a farming operation, you may even go to an accountant for some advice on starting that up and how you manage and record your income and expenses. And they will help you to decide whether you're going to trade as a sole trader, partnership, company, or trust. So you can get advice from an accountant on this matter. Okay, so just moving on, I think that's going to bring us through to our next segment of cash flow. So I'm going to stop there for a moment and see if any of you have any questions on what we've covered so far. And while you're doing that, maybe you're typing one in. I'm going to have a sip of water.
Just have another drink, Jane.
Because I am
Stay
doing
hydrated.
a lot of talking.
You are. You're doing well. But certainly pop some questions in the chat or unmute yourself. And if we don't have a question, Pip, we might flick to a poll question just to see how everyone's tracking along.
This is to help give me a little bit of a break, talking break to everyone. So if you can, participate in the poll, that would be great. So we're just asking there, what finance options have you used in your business? And you can select all that applies, so you can provide more than one answer. And we're submitting that through. So hopefully Pippa's seeing some responses come through. I'm not sure if I can't see any responses coming up from the polls, but I'm not sure if anyone else knows.
We've still got the odd one coming in, so I'll just leave it for another 10 seconds if anyone else wants to add theirs, and then I think I should be able to get it up so that we can see the results.
Okay, excellent. And I think
Pippa, while you're doing that, Liz has got a quick question for you, Jane. So when would you advise changing to a company instead of a partnership?
Okay, so this is a really excellent question. Thanks, Liz, for sending it through. So that is something that, is worth considering because, and one of the key things, there's a couple of key things actually in considering here. So if you're trading as a partnership of two individuals, so as I said, that might be Sarah Wallace and Jane Foster, and we're trading. If there's any challenges or issues in the business, Sarah and I would be individually legally liable. So that's one aspect of a partnership that is different to a company. If you're in a company structure as proprietary limited, we would be potentially both directors of that company and we might be shareholders. But unless there's certain specific circumstances, our personal liability is more limited. And so that is part of the reason that some people choose to use a proprietary limited company. And then the second reason for it is that companies have a particular taxation rate. So it's around 27 cents on each taxable dollar of income. Whereas for individuals, we're on a taxation scale. So there is a point at time, and I know for individuals that scale ranges up to about 45 cents per dollar of taxable income if your taxable income exceeds $180,000. So there is a point at which sometimes two individuals in a partnership generating taxable income, their average tax rate might be 38 or 40 odd cents in each dollar, and at which case they may get advice from their accountant that actually now would be a good time to consider moving across to a company structure because it may be beneficial from a tax perspective. And the secondary aspect that I've had a number of clients recommended to move to maybe a trust or a company structure is to protect themselves from personal liability. Now, if you're dealing with a bank and you're borrowing money, if I had a company, JF Proprietary Limited, and it borrows money from the bank, generally speaking, the bank will make sure that they still have a way of collecting the money from Jane Foster as well. So when I say that liability can be limited, it's the liability that might arise just from generally conducting a business. When you're actually borrowing money, often those finance providers will find a way to ensure that you are personally liable for the debts that you incur in the company as well. So I just wanted to make that clear when I say limiting liability. It's not really related to money that you might borrow, okay? So hopefully that answers that question. And there's another question, now, Simon, I think.
Yeah, so Simon, I'm not sure if you can answer this quickly, Jane, just mindful of time.
Yeah, sure.
What should we look for in seeking a good agri-finance broker?
Yeah, so a good broker will be somebody who probably understands the industry that you're in and asks really relevant questions, that is available. And the one thing that they would tend to have is good contacts with the banking and finance networks. There are actually a couple of dedicated agri finance brokers around now, so they can be a good starting point. And generally speaking, you'll find a number of finance brokers around, particularly if I think of the example here in Bendigo, there's quite a number. Some of them are more, I guess, familiar with the agricultural space than others. Some of them only do really home loans. So a home loan broker is probably really not going to be able to help you so much in this space. So you want to look for someone who specifically probably mentions that they can deal with agricultural loans or machinery loans and finance. They would be the ones to look out for there. Alrighty, well, if we probably should be able to see on our screens now what finance options have you used in your business. So 50% have had an overdraft, 45 term loans and equipment loans. So that would be as I'd expect. They're the predominant categories of loans. And then a few have used stock loans, vendor loans, private loans or seasonal crop finance. And there must be a few that used other types of finance not specifically mentioned above. So thanks all for participating in that quiz. That's great, or the poll, I should say, more so than a quiz. Okay, so now we're moving along and we're going to be looking at cash flow. So earlier, you'll recall I did mention that we'd be talking about working capital further on. So working capital is really the, I suppose, engine room in some ways of the finances of the business. And working capital is the ability to meet your expenses with income or assets. Now, the current assets in terms of a business is often things like your cash in the bank, because obviously that's pretty easy. If you get a bill, you can pay it with cash in the bank. But other things, this refers to inventory, but for instance, if we do have some livestock and we can sell them in a market, we can fairly quickly convert them to cash. So that means that then we obviously use the cash to then pay the expenses. So working capital is the available cash in the bank or the assets that we can quickly sell to generate cash in the bank. And your current liabilities would be the things that you have to pay at fairly short time frames. Like if you purchase some fodder, you might be able to get someone to give you 30 days to pay for it. They'll give you an invoice. And so while you have that money that you owe, that would be considered a current liability, because it basically means you have to pay that in a fairly short time frame. You don't have years to pay for it, which probably makes sense when we're talking about fodder and grain, which you're going to use quite quickly. So working capital, it's important, I guess, that we have generally more current assets in the business than current liabilities, because that means we're going to be able to, at some point, pay all those current liabilities. So moving on, and I've generated here an example of a cash flow. And so what I wanted to show you about this is that we run through, and for instance, in some months, we may actually not generate any income. Income is demonstrated by the orange bars and expenses by the grey bars. So I look in January and I've had some expenses, but no income. So if we look below the line, the green line demonstrates where the actual bank balance is. So we start off in January, and at the end of that month, our bank balance would be about minus $7,000. And so that's what I was referring to when I was talking about an overdraft. That overdraft limit, if it's $20,000, that's okay. We paid our bills. We overdrew the account by $7,000, but the bank's provided us with a $20,000 limit. So one thing that is particularly important when we're looking at being able to make an application for finance or going to a bank, they do like to know what our cash flow will look like over potentially a future 12-month period. Now, these don't have to be really overcomplicated documents. Generally, you can produce a cash flow in Excel. And so what you'd normally do there, and I will demonstrate that in a lot more detail when we catch up next time for our next session. You just run through month by month, and you would list out, what you expect income is. So you might know that based on if you're producing lambs, roughly when you're going to sell them, how much you might expect to receive. And so you'd put that in as income for that month that you receive it. And then you go through and do a similar thing with your expenses and list those out. And so the main thing that's important when we're looking at establishing our business case is knowing that we've got enough available funds to run the business. And so doing a cash flow is a really good way of demonstrating that we know what our income and expenses might be over the next 12 months. Now, it's understandable that it is a business, so sometimes these things are not exactly precise, but it is a good starting foundation and something that if you do this for a newer enterprise, then you'll be able to have a look and forecast. It might be that you do have to be able to trade for up to 6, 7, 8 months without receiving any income. So you'd really want to have a good idea of what that might mean. So this type of business, you'll see, it might be the feedlot example. And we obviously don't sell any cattle in January. We sell some in Feb, March. In April, we've sold quite a few, and our expenses were less than the money we received in. But maybe in June, we have to buy in a bit of extra fodder or grain. So our expenses are quite high in that month. And then we might do that in December again. But the main thing to know is, can we actually manage all of the income and expenses? I'll just show you quickly an alternate scenario. This might be a cropping enterprise where we do pay most of our expenses all the way through October, and we don't start receiving money until November. Okay, so that's probably as much as I want to mention on cash flow. Because we are, as I said, I'm going to spend quite a lot of time going through that in detail next time. And now I'll move on, matching resources. So a really important part of a business case is understanding what we actually need to be able to run the business and how we're going to acquire those resources. So I'll just give you a few examples to work through here, and these might be slightly different dependent on what type of farming business you're running or looking to run. But it's a really good way of just ensuring that everything that we need to be successful, we know how we might acquire, or that we can set about investigating how we will acquire. So an example here is land. We might lease that from a third party, livestock, we can purchase that through markets. That's relatively straightforward. Another thing you want to consider if you do lease some land, how far away is that from the markets that you might need to access to sell what it is that you're producing. Water, so in the feedlot example, obviously water availability and reliability will be really important because any of those cattle in the feedlot are going to need access to clean, fresh water. Grain and fodder, availability and price, and also when I say availability, how close is that able to be purchased from where we're based, because the transport costs will obviously increase the cost of the grain. And then if you do have livestock, you're going to need some yards available to handle them and manage them. So the suitability and setup of those yards. Transport, access to locations. So if it is livestock, can you get livestock carriers in and out of the property so that they can, you know, take cattle or sheep to market on your behalf? Or if you have transport, can you get it in and out of the property? And then last but not least, labour. If this is something that you can't manage and run on your own and you're going to need help from people that you employ, are there suitable and skilled people available close to where you are? Because generally speaking, the further you are from where they are, the harder it can be to get them to come and work alongside. So that's a bit of a summary and overview, and it's quite broad, but as a bank manager, I would often be quite interested to know, had people gone through, especially if it was a new enterprise, had they gone through this sort of checklist, and could they demonstrate to me that there was access to all the required resources that they would need to operate the business effectively, and secondly, profitably, because if they were conducting some sort of business which was, for example, a long way from the markets that they were intending to sell through, then that might affect their profitability because they had to pay increased transport costs. So I'd want to have some idea that they had factored those sorts of things into their decision process. I'll just quickly run you through some farm business initiatives that you might be participating in at present, or you might have heard of, or some of these might be some thought starters. So there might be an opportunity to undertake profit share arrangements. So you and someone else might get together to conduct a farming business. If you don't have a lot of money to invest, they might invest or they might provide the money, but you might provide the labour. And sometimes you might hear the term sweat equity. And so that's where we basically do a lot of the work ourselves, so that then at the end of the day, any profit, we get a share of that basically for our effort in labour. And the reason you might do that is because you might actually end up with more money at the end of the day participating in something like that than you might earn perhaps doing the job on an hourly rate or a set wage. Share farming arrangements, they tend to be not uncommon. You see them a lot in dairy industry, where the share farmer might own the dairy cattle, and they engage in a arrangement with a landowner, and they conduct dairy operations, and then they split the income at the on an agreed percentage, basically, in dairy, probably on a monthly basis. Leasing land's quite straightforward. So someone owns the land and you just pay them an annual fee to lease the land off them, and then you conduct your farming operation or enterprise on that land. So you don't have to have the cash up front to buy the land, but you just need to ensure that you can meet that annual payment. And then contracting services, this is something that we see used quite a bit, where you might be able to obtain some plant and equipment. So in cropping, it's not unusual to see people providing contract spraying service, and then you can go around to other farming businesses and charge them a contract fee. And it essentially can, if the spray unit and tractor is under finance, providing the spraying services to other people helps you pay that off. And of course, agistment is where you have livestock on someone else's property and you just pay them a rate for the amount of time that the livestock's on their property. Okay, so hopefully that's given you a few thoughts, and you might actually develop or design a business case that utilises one of these types of initiatives. So you might come across a share farming arrangement that you can participate in, and then you can look at a business case for yourself and understand, you know, how much money you might need up front, how much money you might need to pay expenses along the way, and if you do have any need for some machinery or equipment finance, then you can identify that and go about finding a loan provider that's happy to assist. So I might just say there, Sarah, are there any further questions from the group? And then if not, we can sort of wrap up with a bit of information on where you can go for further assistance. Okay, it seems quiet on the chat. Someone might be out there madly tapping away a question to me, so we will give you a minute or two.
Yep. And we can probably pop up a couple of polls while we're waiting for people to Pippa.
So while we're doing that, I might just put the slide up as to where you can go for more information and industry resources. And I definitely encourage you, if you are looking for assistance, there's rural financial counselling. Oh, there we go. The polls just popped up. So, and this would be a great question. I'd love to know, are any of you currently involved in any of the following arrangements? Profit share, share farming, leasing land, contracting services, or agistment? So just select your response and submit the answer through, and Pippa will be able to see those coming through. So while we're waiting for everyone to do that, so there is rural financial counselling service across Victoria, and they will be relative to your local region. There is a web link I've provided there, which is on the Agriculture Victoria website, which basically will help you identify which rural financial counselling service you can refer to depending on your local region. So by all means, take some time to investigate that if you'd like some more specific advice or help, and Sarah's just popped that link into the chat box. Thanks very much, Sarah. Okay, and we've got the poll results there. So really interesting and great to see. So 31% are involved in a profit share arrangement, 46 are share farming, so that's a great result. Leasing land, and I'm probably somewhat surprised that that's the same percentage as share farming. It seems to be probably leasing is slightly more common when I'm dealing with farming enterprises. There's about 38% out there conducting contracting services and 46% utilising agistment. So it seems like it's a really varied mix. It's great to see. Okay, I might just close that there. And of course, yeah, we are on an event tonight hosted by Agriculture Victoria. So we thank them for putting this on for us all to have a chance to, or specifically for me to have a chance to chat to you all and talk through some of the key components of a business case. And second to that, if based on your industry, you will have generally an industry research and development organisation that you can refer to, and they provide a lot of information and technical support. So a few of those are listed there for you. And basically, I think a quick Google search of meat and livestock and you'll get through to their website, and you'll find a lot of resources available if you're particularly for those industries there. And there are others. They're probably some of the main ones that I thought I'd represent tonight. So
thanks, Jane. And Liz we've got another question from Liz around recommendations for do's and with machinery finances.
Yes. Okay, I do have some do's and don'ts with this one. So just with machinery finance, sometimes you can put what they call a balloon on the end. So if I buy a tractor for $40,000, I might be able to put a balloon on the end of $20,000. And that will reduce my monthly payments, because what that means is if the loan's a 5-year loan, I'll pay my monthly payments over 5 years, but at the end, a $20,000 balloon will be payable. So if we're going to do something like that, we just want to be really sure that that asset will be worth at least $20,000 at the end of that 5 years. And so that's also relevant to motor vehicles. Nothing worse than you get down the track 5 years later, the car's 5 years old, you might sell it or trade it in and the car's worth less than what you owe. So just be a bit careful with how those are structured. And probably my second point would be, if you have a chance, just shop it around a little bit. So brokers generally will do that for you to get you the best rate. But, you know, if you're in a car yard, for example, and they've got a finance provider on site that offers you a finance deal, just maybe check with someone else that, you know, there's no hidden fees, charges or costs, and that it's a competitive finance quote, because sometimes they might put in quite a low interest rate, but then once you set up the loan, there's quite a lot of fees and charges. So just make sure that that's all disclosed up front and that you understand exactly what you'll have to pay over the term of the finance. A preference between banks and dealerships. I wouldn't say so much a preference. Wherever you can get the best deal, that's where I'd probably be going. So sometimes that's banks, sometimes it's not. But just ensure that they have disclosed all of the fees and charges, which generally banks are obligated to do. So they'll be quite upfront with that. And just compare the interest rates and the total amounts of all the repayments that are payable over the term of the loan. Okay, I think we've got an evaluation poll to complete, Sarah, before we sign off.
Always.
Yes.
Always, Jane. Thank you. But Jane, even if you want to just flick up the next slide, which has got the dates for the next
great idea
round, while Pippa's getting that up. And there is a link in the chat to register for the Creating the Cash Flow Budget session on the 8th of April. So if you haven't already, register for that one.
Yeah, so I see Pippa's put the link to register in the chat box, so that makes that pretty easy. And as I mentioned a few times, I'll be really going into creating the cash flow budget in detail. And I wouldn't underestimate how important sometimes a cash flow budget can be as the difference between being able to sort of successfully obtain finance, or maybe, you know, they not as able to provide you with finance for your farming enterprise. So really encourage everyone to tune into that one.
Thanks so much, Jane. Great job. How are we going? Sorry, it's frustrating not being able to see where we're up to with the polls. First, we've got some.
Oh, sorry. That second one's meant to read after. Apologies. Don't know what happened there. But late now. We'll just I can't change it now that I've launched it, so I'll just have to rely that, yeah.
Well, I'm glad that you've read it. That good, to me is a success that you've noticed, you've read the questions and you've had a go. So well done. It is very close to 8:30 on a Thursday night. So well done, everyone.
Yeah.
So
Thanks.
just, do your best.
Thanks all. It's been great to spend this time with everyone. And I'll go to the next slide just quickly. Contact details for myself or Sarah. So if you did have any follow-up questions that you want to send through direct, more than happy for you to do that. Just at the start of your email, if you want to email just at the start, just mention that you were on this webinar tonight and shoot me through any direct questions, or if you had other questions, Sarah, you're happy to take those as well. Great.
Definitely.
And then I'll go back to the dates to make sure you know when all of the next series are happening. So they're all Thursday evenings. Well, we actually haven't decided a time, have we, Sarah? So we probably will do that.
Yeah, I think it'll be dark. I mean, I know 7 o'clock cannot be, great with little kids, but if it gets much later, then we all get a bit tired by the end of it. So it's a bit of a balance there. But look, we did ask. So recently we did a survey of, finding out young farmers how they like to engage online, and Thursday evenings seemed to be a preference. And we then backed that up. We asked you guys in the Young Farmer Facebook group what time slot would suit you for a webinar, and the majority of the responses were for this time slot. So we did ask, and we did set it up at this time based on that, and we have had, a fairly good turnout tonight. So I think, and we've recorded it, so we're welcome to, catch up on a recording if you miss it. So.
And there was just a question from, I think it's Johan, about the presentation being downloadable. So Sarah, are you looking after that, or?
I've just answered that one in the chat. We have recorded tonight's session. Beautiful. And we will be sharing it on YouTube. So a link to, once it's up on YouTube, we will then email out a link to everybody who's attended tonight. So you'll be able to access it again via the link and have another listen to any of those really important bits.
Yeah. So great. Well, I definitely hope that's got you started anyway with some thoughts and ideas around putting together a business case. It's been really great having a chance to go through this with you, and I'm looking forward to creating cash flow budget on the 8th of April. I do love a good cash flow, so.
And we all will too. That's awesome. Thanks for the great feedback, guys.
Yeah,
we really appreciate it.